Japan is on the brink of a silent financial collapse, and if you think this is exclusively their problem, you should know that this crisis has the power to drag the world's largest economies into the abyss, including the United States. The countdown began in late 2025, when Tokyo's financial market suffered an unprecedented seismic shock. The Japanese government's 40-year bonds hit an interest rate of 3.7%, an all-time high since these securities were first issued. In a matter of seconds, panic crossed the ocean. U.S. interest rates spiked. Bitcoin melted down, plummeting from $120,000 to the $90,000 range, and Wall Street went into total shock. The reason behind this chaos is simple and terrifying. Japan is the most indebted nation on the planet. Their debt already exceeds 260% of their GDP. This means they owe 2.5 times everything the entire country can produce in a single year. For the sake of comparison, the United States, frequently criticized for its debts, operates at around 125% of its GDP. Greece, which almost bankrupted the European Union in 2011, reached 190% at the peak of its crisis. Brazil hovers around 90%, and Argentina is at about 75%. Japanese debt is a ticking time bomb that could pulverize global finance. But before we break down how this gear broke and how it directly affects you, do a quick favor for the channel. Leave a like and subscribe. That way, the YouTube algorithm knows you enjoy deep dive content like this. Now, let's get to what really matters. How can a 3.7% rate in Japan bankrupt the rest of the world? Let's demystify this. When a government needs money to build highways, pay public servants, or fund healthcare, it issues government bonds. It's basically the state taking out a loan from investors and promising to pay the money back with interest after 10, 20, or 40 years. The massive problem arises at maturity. Imagine that a decade ago, Japan borrowed billions while paying a measly 0.5% interest per year. Back then, money was practically free. The catch is that those contracts are expiring now. Since the Japanese government doesn't have the cash on hand to pay back investors, it does what any desperate debtor does. It takes out new debt to pay off the old debt. The tragedy is that the new interest rates have jumped to 3.7%. The cost for Japan to roll over its debt just became 7 times more expensive. Putting it into real numbers, Japan's debt is in the neighborhood of 1.1 quadrillion yen, about $8 trillion. When the rate was 0.5%, the country spent 13 trillion yen a year just on interest, which already consumed a quarter of the entire nation's budget. At the current rate, the government needs to shell out an extra 40 trillion yen per year. That is equivalent to 5 times Japan's entire defense and military budget. To balance this sheet, only 3 ways out remain. Drastically cut essential spending, healthcare, education, and pensions, which is political madness. Raise taxes, suffocating an economy that has already been stagnant for 3 decades. Issue even more debt, which is like using the limit on one credit card to pay off the bill of another. The market has already realized that the third option is the only realistic one, and the warning light has flashed on. When investors demand higher interest, they are saying, the risk of you defaulting is massive, so we are charging you more to lend you money. It's the equivalent of having a ruined credit score at the bank. And when this happens to the world's 4th largest economy, the impact is global. Japan is Washington's largest foreign creditor. They hold more than $1.2 trillion in U.S. Treasury bonds. For half a century, Japanese money has financed America's growth and deficits. However, if interest rates in Japan rise, local investors would rather keep their money at home than send it to the other side of the world. Without the Japanese there to buy American debt, the United States is forced to raise its own interest rates to attract new buyers. It's the law of competition. If Japan offers attractive rates in a currency that is historically more stable and has less inflation than the dollar, the U.S. needs to strike back by raising its yields. That's where the domino effect wreaks havoc on the planet, forcing central banks worldwide to raise their interest rates as well. The Japanese political leadership itself has already publicly admitted that the country's fiscal situation is more alarming than the 2011 Greek crisis. And to understand how the land of the rising sun got into this dead end, we need to take a brief trip back in time. On December 29, 1989, the Nikkei index, the Tokyo Stock Exchange, reached its historic peak, 38,915 points. Japan was an unstoppable superpower and was on the verge of overtaking the American economy. Brands like Sony, Toyota, and Mitsubishi dominated the planet. Out of the 10 largest corporations on Earth, 7 were Japanese. The euphoria was so intense that the land underneath the Imperial Palace in Tokyo, all by itself, was valued higher than all the real estate in the entire state of California combined. Japanese companies were buying up American symbols like the Rockefeller Center and Hollywood studios. The future seemed to belong to them. Until the bubble burst in 1990. In a single year, the stock market crashed nearly 40%. Residential real estate plummeted by half, and commercial property melted down by 85%. Billions vanished, banks inherited mountains of bad loans, and Japan plunged into what became known as the lost decade. In reality, it has been 30 years of paralysis. In 1995, Japan's GDP was around $5.5 trillion. Today, it has shrunk to about $4.2 trillion. To try to revive this blown engine, the government spent decades building massive public works projects and pumping artificial money into the market, accumulating the monstrous debt we see today. Why didn't Japan go bankrupt sooner? The answer goes by the name of the Bank of Japan. To force the economy to move, the Japanese central bank took an extreme measure. It cut interest rates to zero in 1999 and in 2016, pushed the rate into negative territory. Basically, banks charged people to hold their money, forcing citizens to spend or invest it so they wouldn't watch their wealth melt away in their accounts. Furthermore, the Bank of Japan started massively printing yen to buy up the government's own bonds. Today, the central bank owns more than 50% of the country's entire public debt. In the U.S., the Federal Reserve owns just 14%. Surprisingly, this rampant printing did not trigger immediate hyperinflation due to a cultural factor. Japan was suffering from deflation, falling prices. Since the population knew things would be cheaper in the future, they delayed spending. Companies, left with no customers, froze investments and wages for generations. Everything changed in 2022 with the war in Ukraine. Japan, which imports almost all of its energy, saw costs explode. For the first time in 30 years, inflation knocked on the Japanese people's door, reaching 4%. The yen weakened drastically, making food and fuel incredibly expensive for a population with wages frozen for decades. Popular discontent forced the government to promise subsidy packages they cannot afford, pushing bond yields to the current high of 3.7%. To make matters worse, Japan is facing the world's most severe demographic winter. The number of deaths is double the number of births. With nearly a third of the population over the age of 65, there are fewer and fewer active workers to sustain the public machine and pay taxes. Tax revenue is shrinking, and the only way out is to issue more debt. This is exactly where the problem explodes globally through a financial maneuver known as the carry trade. For years, massive global funds borrowed money in Japan at zero or negative interest rates, converted it into US dollars, and invested it in the US to yield 5% a year. Easy, cost-free money. Estimates suggest this financial engineering moves over $20 trillion, a figure larger than the GDP of China. This gargantuan flow of cash helped inflate global stock markets, real estate, and cryptocurrencies. However, when the Bank of Japan recently started raising interest rates to curb domestic inflation, the yen surged. Suddenly, international investors realized that the cost of paying back their yen-denominated loans would become more expensive than the profits they were making in dollars. The result was a widespread stampede to liquidate positions. On the recent, historic Black Monday, the Tokyo Stock Exchange plummeted 12% in a single day, the Nasdaq melted down, and Bitcoin lost more than 20% of its value in a week. All of this was triggered by a measly 0.25% interest rate adjustment. The terrifying danger is that analysts calculate only about half of this immense carry trade market has been unwound. There are still roughly $10 trillion hanging on to this financial tightrope. With money permanently becoming more expensive in Japan, the countdown for the rest of this capital to flee the market has already begun. The big question now isn't whether the global bubble will burst, but how much time is left before the final impact. This financial roller coaster used to help keep interest rates in the United States artificially low. Because the demand for U.S. Treasuries was massive, Washington didn't have to break a sweat to attract buyers. But the playing field has changed. Now, Japanese institutional giants, like insurance companies, banks, and the largest pension funds on Earth, have begun making a logical yet dangerous calculation. Why should we leave trillions of dollars in the United States yielding 4% when we can bring that capital back home to Japan, pocket 3.7%, and completely eliminate currency exchange risk? This is where Wall Street's ultimate nightmare lies: mass repatriation. If Japanese investors start dumping their U.S. bonds to bring their money back home, an avalanche of $1.2 trillion in American debt securities will hit the market. When supply explodes and demand vanishes, the price of these bonds plummets. To compensate and lure in new buyers, the United States will be forced to spike its own interest rates. For the White House, this is a fiscal catastrophe. Currently, the U.S. already spends about $1 trillion a year just to pay the interest on its own debt. Another rate hike would add hundreds of billions of dollars to that tab. And where will that money come from? There are only two paths, and both are horrific. More debt, pushing the snowball down the mountain. Massive dollar printing by the Federal Reserve, which would inevitably trigger a new wave of global inflation. There is no painless way out. And you, even living thousands of miles away from Tokyo, will feel the impact. When American rates spike, central banks worldwide are forced to raise their own interest rates to stop investors from fleeing their countries. The result? Expensive mortgages, restricted credit, businesses cutting investments, and the economy slamming on the brakes. You could end up paying the price simply because the world's biggest creditor ran out of breath. To worsen the perfect storm, Japan is grappling with an unprecedented social and political crisis. The country's leaders have plummeted in popularity because the population is furious over the cost of living. Remember, we are talking about entire generations of Japanese people who had never seen prices change. Now, with inflation eating away at their purchasing power, the mood on the streets is one of protest. To try and calm things down, the government announced a desperate $135 billion stimulus package. More fuel on the debt fire. While the traditional system cracks, a silent movement is gaining traction in the Japanese corporate market. A company listed on the Tokyo Stock Exchange called Metaplanet decided to convert its cash reserves directly into Bitcoin. The result? The company's stock exploded. Japanese investors are viewing crypto assets not as speculation, but as a shield against a melting yen and the incompetence of bureaucrats. When you lose faith in your country's currency and its central bank, the natural instinct is to migrate your wealth into scarce assets. Assets immune to a politician's pen and that cannot be printed out of thin air. This doesn't mean the entire Japanese population turned into crypto enthusiasts overnight, but the speed of adoption reveals an uncomfortable truth. Faith in the traditional financial system is evaporating. And in economics, confidence is everything. When it vanishes, a collapse stops being a hypothesis and becomes a countdown. The million-dollar question is, when will Japan finally break? The most honest answer is that no one can predict it with exact precision. The country has been balancing this plate for 3 decades. This agony could drag on for another 5, 10, or 20 years, or go up in smoke tomorrow morning. But history teaches us a brutal lesson about debt bubbles. When the collapse comes, it happens at the speed of light. Let's look at 2 famous cases from the past. Greece in 2010. It all started with a debt of around 320 billion euros. The government was spending more than it took in and cooked the books. When the market caught onto the bluff, distrust froze the country in weeks. Interest rates on Greek debt shot up from 5% to over 30%, Unemployment swallowed a quarter of the population, and GDP shrank by 30% in just 5 years. The Athens Stock Exchange melted down by 80%, triggering massive bank runs and civil chaos until the IMF and Europe staged an emergency bailout. Argentina in 2001. The country declared the largest sovereign default recorded up to that point, $100 billion. The economy imploded, the peso turned to dust, bank deposits were frozen in the infamous corralito, and the political chaos was so severe that the country went through 5 different presidents in less than a month. Now, pay close attention to this technical detail. At the absolute peak of its historic crisis, Greece's debt was 190% of its GDP. Japan today is operating at 260%. There is, however, a crucial difference that makes the Japanese case far more dangerous for the planet. The Greek economy was worth about $200 billion, Argentina's around $600 billion. Japan is a $4.2 trillion titan, more than 20 times larger than Greece. If Athens sent a shiver through Europe, a collapse in Tokyo would cause a full cardiac arrest in global trade. There is another factor compounding the Japanese trap. Unlike other emerging markets, Japan doesn't owe money to foreign banks or international funds. Roughly 90% of its debt is domestic. The government owes money to its own citizens, its local pension funds, and its national banks. An outright default would wipe out the life savings of its own elderly population. No government survives that. Therefore, the most likely exit won't be an official bankruptcy announcement, but rather a stealth default via inflation. The Bank of Japan will keep cranking up the money-printing presses to buy government bonds. On paper, the debt gets paid. In practice, every yen in circulation becomes worth less. It is a silent transfer of wealth. The government clears its slate by destroying the purchasing power of its citizens. More pessimistic analysts point out that global superpowers, including the United States, might eventually adopt an even more aggressive tactic: financial repression. This means creating complex technical regulations to force domestic banks and pension funds to use citizens' private savings to buy government bonds with yields far below the rate of inflation. They won't confiscate your balance directly from your account, but they will force the system to lend your money to the state at deliberately low interest rates. You get poorer slowly and imperceptibly, while the government extends its financial lifespan. Japan is not alone on this collision course. It is just the passenger riding in the first-class cabin of the train. The United States is carrying a debt that surpasses $38 trillion and shows no signs of stopping. Europe faces economic paralysis with public spending out of control, and even China's debt has doubled over the last decade. The entire planet got hooked on cheap money and infinite credit. The bill has arrived, and the math is unforgiving. At some point, the price will have to be paid. Those who are paying attention and prepared will not only be able to shield their wealth, but find opportunities where the majority will only see chaos. If this content opened your eyes to what goes on behind the scenes of the global economy, don't keep this information to yourself. Share this video with anyone who needs to understand the scale of the current risk. Check your subscription to the channel and turn on notifications. See you in the next video.